On October 14th, during the week of JP Morgan's earning, CEO Jamie Dimon remarked that there are cockroaches in the market to describe the concerning situation in the private credit. Dimon said that when you see one cockroach, there are probably many more. So, why is Jamie Dimon and Wall Street so concerned about the private credit market? To understand the origin of their concern, we first need to understand how private credit works. Private credit operates by having an institution pooling money from investors and deploying that capital in the form of loans or credit to various businesses and projects, such as infrastructure. By that description, its core lending operation is similar to a bank or a credit institution, but with far less scrutiny. Unlike traditional banking, which is heavily regulated and requires public disclosure, private credit deals often involve little to no public reporting. They are structured as one-off agreements between the private credit fund and the borrower, making it nearly impossible for outsiders or even regulators to accurately assess the true risk across the entire system. Over the past decade, private credit has seen remarkable growth, mainly due to increased regulation on US banks after the 2008 financial crisis. This drove capital to private credit funds that can allocate capital with fewer requirements and more flexibility in how they structure their lending, allowing investors to generate higher yield premiums in a low yield environment. While there have been discussions surrounding whether the rapid growth of private credit can lead to risk to the financial system, this concern didn't materialize until recently when the company Tricolor and First Brands declared bankruptcy. Tricolor is a subprime auto lender that lends primarily to immigrants who cannot get access to car loans from traditional financial institutions. With increased pressure on deportation under the Trump administration, the firm came under pressure and suddenly declared bankruptcy on September 10th. It has lines of credit from banks including JP Morgan and Barclays. While you can attribute the bankruptcy of Tricolor mostly to circumstantial and one-off factors given the current political situation, the bankruptcy of First Hands, an auto parts company, is far more troubling. When the firm declared bankruptcy on September 24, it had accumulated over $10 billion in liabilities to banks like Jefferies and UBS. In hindsight, as Bloomberg reported, signs of trouble have been piling up for First Brands, including Zoom calls where the owner kept his camera off, angry pushback from his brother when investors asked for invoices to back up their loans, frequent late payments to suppliers, and whispers of large off-the-book financing agreements. And this is the core of the issue, the chase for market share between different private credit funds. Banks and private funds want to be the ones to execute deals quickly because they fear missing out to competitors. This fear of missing out has led banks like Jefferies to skip proper due diligence and fail to scrutinize these companies as they should when they're lending out billions of dollars. Many banks and private lenders have traded down following the collapse of Tricolor and First Brands. Jefferies, which has large exposure to First Brands, suffered an over 30% decline in its share price and extensive reputational damage to its business. And in the broader market, regional banks all traded down, with the S&P Regional Banks Select Industry Index plunging by 6.3% on Thursday, October 16th. And banks with a greater exposure to these bankruptcies, like Western Alliance, saw their share price sliding over 10% on Thursday. So, what's the ultimate concern about these financial cockroaches? It's not just that one company, like Tricolor or First Brands, went bust. Rather, it is the opacity of the entire system. Because this market grew so fast, with so little oversight, and with such fierce competition driving poor underwriting standards, Wall Street is forced to ask a terrifying question. How many deals that look good on paper are actually rotting in the dark? Jamie Dimon's warning is not about a single bad loan. It is about a systemic blind spot. The worry is that the losses aren't confined to private credit funds, but that they could also bleed into the highly leveraged regional banks that help finance these funds. As we saw with the market drop following these bankruptcies, the slightest crack in private credit sends shockwaves across the entire financial system. Ultimately, private credit might be an innovation that offers capital where banks won't, but without clear oversight, it becomes a massive, unregulated balance sheet lurking outside the traditional banking system. For now, regulators and Wall Street can only hold their breath and wait for the next cockroach to crawl into the light. The question isn't if more will appear, it is how big the infestation really is.